world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here. Hello and welcome to Rebank. I'm your host, Will Beeson. Today we're thrilled to be joined by Simon Cant and Danny Gilligan, founding partners of Reinventure, an Australia-based fintech venture capital fund. Simon and Danny are entrepreneurs, and they bring that experience and mindset to venture investing. We cover a number of interesting topics today, including how Reinventure thinks about fintech investing, how best to engage and support startups, where fintech is going in the next decade, the untapped opportunity in data, and more. If you like today's show, reach out. Tweet at us at Rebank Podcast or at me, your host, at Will_Beeson. You can subscribe to Rebank on iTunes or your podcast platform of choice. Thanks so much for joining us today. Please welcome Simon Cant and Danny Gilligan. Danny and Simon, welcome to Rebank.
Thanks, Will.
Pleasure to be here, Will.
You guys co-founded Reinventure, a venture capital firm, in 2013. Your largest investor is Westpac, one of Australia's biggest banks. For context, can you tell us a bit about the structure of the fund?
Sure. So the structure of the fund is pretty critical, I guess, to the whole approach that we're taking. This was a model, a new model of corporate venture capital that we pitched into Westpac, based on a bunch of experiences we'd had in the media sector about what didn't work when they were trying to create a defense to disruption. And what became clear was if you were going to do a corporate venturing defense to disruption, you really needed to firstly ensure that the capital was separated from the balance sheet of the corporation, whatever it was, bank, etc. So the first element to the structure is committed fund. And our first 50 million was set up as a standard VC fund with an independent management company that Danny and I own, and Westpac and ourselves as the sole LPs in that fund, and obviously committed funds with a 5 to 15 year horizon for the fund. There are a couple of things that addresses. Firstly, it ensures that we can manage our fund in vintages, essentially. So if we make an initial investment out of a fund, then we're confident that we've got follow-on capital if that investment, if that venture is succeeding. It also ensures that we have that level of independence from the bank. So we think outside, we don't think through their strategic lens. We actually think through a capability lens from Westpac. So what in the Westpac asset base, what in the Westpac know-how, what in the Westpac capability set could we leverage, could we lean into a venture with in order to help that venture succeed? And coming from that lens in making our investments frees us up from having any discussions with the bank about is this strategic for the bank or is this not strategic for the bank? So it really allows us to think in an entirely different horizon to the horizon that the bank are thinking in. They're thinking in a standard sort of 2 to 5 year horizon, as every bank and every incumbent generally is, whereas we're looking at much more of a 5 to 10 year horizon in our investments. So there are a couple of the key elements to the structure, and hopefully that gives you some context.
Yeah, definitely. Is Westpac involved in the investment committee at all, or is that you guys?
Yeah, so it's the two of us and 4 or 5 of Westpac's executive team are involved in our investment committee. So our chair is Gary Thursby, who's the Chief Strategy Officer and COO of the bank. We've got the COO, the CTO, and a couple of other executives from the various business units in the bank. And the role of that investment committee is really to advise us in some of the investments that we're putting forward and to help us drive some of that unfair advantage from the bank into the venture through their sponsorship of those investments. But we've got the authority to make investments up to $1 million ourselves, just on notification to our investment committee, which means we're able to move at speed for seed investments, which is often necessary. and the Westpac members of our investment committee have a veto right over investments between $1 and $6 million. And that's something that we had suggested as part of setting up the fund to ensure that we had that independent discipline so that we don't fall in love with seed investments and want to continue to plow capital into them, that there's an independent oversight into the decisions we make around, particularly following on from early stage investments.
Yeah. Well, that makes sense. How would you guys describe your fund mandate? What's the geographic and sectoral scope?
So we're set up under an Australian Venture Capital Act, which basically means 80% of our investments have to be in Australia and 20% of them can be overseas investments. As I said before, our focus is on those investments where something in the Westpac capability set can add significant unfair advantage to the investment. So the way that plays out is typically that we invest in about 3 different areas. One of those is what we call kind of finance at the edge. So where are these kind of marketplaces emerging where financial services is becoming embedded? The next layer is what we'd probably call classic fintech, so next generation lending, next generation payments, et cetera, et cetera. And then the third layer is what we sort of see as the banking stack. So things inside that are used to operate a bank, key assets there, such as data, et cetera, which could potentially be impactful and disruptive, not just to financial services, but potentially to other markets as well.
What drives an investment thesis for Reinventure, apart from Westpac being able to contribute? So you talk about those 3 areas of focus, which I definitely look forward to getting into in a bit more detail. When you guys evaluate investment opportunities, what are kind of the key components that jump off the page to you?
Well, I mean, we can say all the classic stuff that every investor talks about, which is a big market, great team, great product, demonstrated traction, etc. And all of those are true. But I think it's really, for every investor, it's just something that you feel really passionate about, or something that you deeply understand. You can see the opportunity in the same way that the entrepreneur does, and you feel this is something you can get behind for the next 7 to 10 years.
In terms of that support you guys get from Westpac, we've actually talked in the past on the show about the best ways for banks to engage with startups. It's notoriously difficult for small startups that are looking to sell potentially transformative propositions to large incumbent organizations to kind of work their way through the red tape, the corporate bureaucracy that's often required to get sign off to move ahead with a real revenue generating project. Does Westpac structure itself in such a way that blends support to Reinventure's portfolio companies? Are they supportive in moving forward proofs of concept, in quickly running procurement processes and engaging startups in meaningful ways?
Yeah. I mean, this is where the structure of our investment committee has been just a critical element in our engagement with the bank. So having representatives across sort of all of the key business areas and key functional areas means that once the investment's gone up to the investment committee, it's really about who's going to sponsor that and make sure that we can drive through that advantage from Westpac into the venture. And, there's definitely been lessons along the way for us about where are we going to get the stronger lean in from Westpac and where is it going to be tougher. There's no doubt in a large organisation, and I think this would be true for, large modern tech companies as much as it is for more established traditional banks. They're giant organisations that have their own agendas, and you can't always expect that agenda is going to turn on a dime based on an investment that we make. So what we tend to do is sometimes we'll make investments with a view that over the long term, we think this is going to fall onto the fairway for the bank. And we're pretty clear with our entrepreneurs up front if that's the case. We don't say, we're going to do this and we're going to do that in those investments. We say, this is early, let's play it out. We think it could get on the fairway and could be something that the bank could really lean into, but let's just get going and really drive it. And in that case, we begin operating just as a more traditional VC. Then in other cases, we know that there's just this stream of work or this real kind of burning objective within the bank, and this venture will line right up behind that objective. And that's kind of where we feel like we're stepping into a rapid within the inside the bank. And where we do that, we've really seen the bank step right in behind some of those ventures incredibly strongly. So absolutely, the bank adds value, and it's just a constant process of us understanding their agenda, looking at our own thesis, and looking at what's the right way to play it in each case.
Imagine two circles. One is things which the bank is trying to achieve and things which are important to the venture being successful. And where those circles line up strongly, we have huge success. And where there's a small overlap, then that's where we have to sometimes be more patient or be more considerate about whether to make the investment or not. So we've got some instances where those two things have lined up incredibly well. And we're really confident there that the scale of distribution, particularly, that the organisation is able to offer to the ventures is potentially game-changing for them. And the more strongly those things line up, the more powerful that impact can be.
There's an interesting lesson we've learned, which is sometimes those things which are not immediately in their fairway, it's that the most. I often get the most enjoyment when you see them start to come into the bank's fairway over time, and we've had a couple of those, and that's really powerful where that lines up.
So it sounds like deals kind of work to an extent on a case-by-case basis, just because there are a number of goals that Westpac may have and that Reinventure may have, and those may vary deal to deal. But generally speaking, is Westpac looking to make seed investments to later purchase companies? Are they looking to make seed investments into companies that will eventually service the broader Australian incumbent banking market, or does it depend on the deal?
It very much depends on the deal. So Westpac itself isn't looking to anything. So they're very much relying upon us to make decisions in accordance with the overarching fund strategy. And the way we think about it is none of us know what the banking industry is going to look like over a 7 to 10 year horizon. So by investing through that capability-based lens, whereas somewhere where Westpac can add material unfair advantage to a venture, that 1 degree of separation we think is enough to make it a meaningfully relevant option. So even though the bank has no rights to buy anything particular in the funds, that linkage means that we're laying down a portfolio of long-dated options in front of the bank, some of which, as Simon says, will come onto the fairway over time and may be relevant acquisitions for the bank, which they're entitled to make an offer for the same as anybody else, but will be in a privileged position in terms of information regarding that venture through being a long-term investor. And some of which won't come onto the fairway, and if they're successful, then we'll exit for financial returns, and that will fund the overall venture strategy. But trying to guess now what's going to be relevant in 10 years' time is almost an exercise in futility, we think.
There's a case study that we drew a lot of insight from in terms of the way we approach this, which is just the Kodak Fuji case study. So, when disruption hit the film camera industry, Kodak basically just tried to go after a more abstract version of the business they were already in. So they said, we're not a photo camera company anymore, we're an imaging company. And trying to chase imaging was literally like trying to chase marbles under a barn door. I mean, imaging just became an element that was embedded in every piece of, modern online tech. Fuji went almost entirely the opposite way. Fuji basically looked at its capability set and said, what are we good at? We're good at chemicals, we're good at film, we're good at microtechnology. Let's get into some industries that leverage all of those capabilities. And Fuji's bigger and stronger than it's ever been, and we know what's happened to Kodak. So we sort of drew from that when we were establishing the fund and talked to the bank about that case study, and that being the reason why trying to second guess what the future of 10 years might be like, what might be strategic to the bank in 10 years, trying to guess that now was going to be a futile exercise. We were better simply to lay down a set of options from that capability lens.
So one of the reasons that I've I asked you some of these more detailed questions to really understand your structures, because one of the themes that I've been thinking a lot about lately and that we've explored a little bit on the show has been kind of that broad question of competition versus collaboration between fintechs and incumbents, and as relates to collaboration, what the most impactful way for incumbent financial services organizations to engage with fintechs is. Key question for you guys, and hopefully one that you can answer candidly. I think there's strengths and weaknesses of every structure, whether it's a corporate accelerator, whether it's an incubator, or whether it's, in this case, kind of an arm's length corporate venture capital structure. I think we've probably outlined the strengths to a large extent. What are some of the challenges or the weaknesses of this model?
I think the biggest strength that we have relative to other, say, let's call it bank venture funds that we've dealt with over time, and even in some cases co-invested with, is they often don't have a clear distinction between the horizon in which they're trying to solve for in the bank. So they're investing in what we call sustaining innovations, or innovations that are progressing the existing capability of the bank, as well as trying to think about things that are being disruptive in the longer term. And so sometimes that agenda for non-financially driven CVCs, so where the executives are on salaries or other bonuses or incentives, is focused more on solving a problem for the bank than solving the problem for the venture. So whereas in our structure and remuneration model, we're 100% aligned with the maximising the outcome of the venture, aligned with the entrepreneur. So that's probably the single biggest distinction between traditional CVC funds and how we're structured, is sometimes we can see that their objectives are about solving the problem for the bank and not necessarily about being venture first. So being venture first is a really, really important distinction and a huge advantage for us in terms of attracting the quality of entrepreneurs that we want to work with. So the really, really good entrepreneurs understand that dynamic really well and tend to align themselves with investors who are going to be on the same horizon, on the same journey, aligned to their ambition.
Yeah. I mean, I guess from our perspective, we wouldn't say, there's one model that is right for every objective that an incumbent, in particular a bank, is trying to achieve. What we'd say is that for different objectives, there are going to be better structures for how they do for how they do venture capital. Our structure is very much focused. We're very focused on the distinction that Clayton Christensen makes between disruptive and sustaining ventures. And our fund is very much focused on how can we lay down options that will either be part of a disruption over the long term, either to banking or to other industries, but ultimately will create options in a potentially disruptive future for the bank, right? Other models of CVC where it's investing off balance sheet, where they're closer in, where it's more integrated into the strategy, they're going to be much better potentially for banks that are looking to use corporate venturing to pursue their immediate innovation agenda. That's not what we're about. We're about the long-term disruptive agenda. And that immediate sort of sustaining innovation agenda, we often look for certain signals that a particular category or theme is turning out to be sustaining. So, for example, things, when Simple Bank was acquired for $100 million, when Moven decided that it needed to start white labeling to banks, and we're seeing the same happen now in the robo-advice industry, we saw those as signals that particular trend was potentially a sustaining innovation for banks, and therefore should be part of their kind of more immediate innovation agenda, and therefore not a space that we necessarily wanted to invest in.
So switching gears slightly and digging into the three areas that you mentioned before in which you invest. If we could go one by one thinking about those three categories, and maybe you could outline some of the kind of the major trends that are most interesting to you as you guys look at opportunities in the market and think forward the next 10, 15 years.
One is marketplaces on platforms generally. So some of the things that we're focused on there are things that are often particularly close into areas where the bank's heavily involved. So, for example, real estate is a core revenue driver, etc., for the bank. something that the bank can add substantial value to. So we've made a bunch of investments in marketplaces and some platforms that have some relevance to the real estate sector. There are other marketplaces across a variety of industries, so healthcare, hospitality, any number of industries where we think there's some way that financial services is being embedded into the broader experience. And I guess what we've seen with a lot of those marketplaces is this sort of generational change. So the first generation was often really just like a media advertising disruption. So we've seen that with all of the classifieds. And then the next wave became this kind of full stack. I think Chris Dixon from Andreessen Horowitz calls it the sort of full stack venture, which basically curates the entire experience. So Airbnb and Uber are being the kind of leading examples where they curate the entire experience of the user. And in that, financial services is very much embedded. So we've been looking at some of those marketplaces and making investments in some of those spaces. Another space is platforms. Probably I might let Danny chat a little bit about some of the platforms that we've been looking at.
Yeah, I mean, there's a couple of, probably the most well-known example of where we see that finance at the edge thesis being played out through platforms is in Xero. So the accounting software that is going to end up disintermediating to a degree the bank's relationship with small business customers around financial services. We similarly invested in a business called Flair, which is like Xero for HR. And whilst that might not sound particularly relevant to fintech, what we find is in the Australian superannuation market, which is the third or fourth largest in the world, almost $3 trillion of assets in that category, distribution is the key to disrupting that space, not shifting to robo-advice platforms. And so the key decision point for people making choices around the superannuation fund provider is in the onboarding process when they join a new company. And so actually being the HR platform that controls that onboarding process and can heavily influence the decision around which financial services products an employee as a consumer takes in that all-important transition is a critical moment and a critical point of disruption in distribution we see. So there's an example of a small business HR platform being used to effectively disrupt the distribution of consumer financial services products to employees. And so and similarly with Xero for small business finance and small business financial services, Flair for consumer financial services and products. That's an example of the decision-making and distribution of financial services being sucked into adjacent platforms.
And then if we look at the kind of next layer, which is that classic, what we'd call more classic fintech, some of the disruptions there, they're typically about the fact that, financial services and major banks have typically operated within a fairly narrow band, which based on, more traditional credit scoring models, etc., have been comfortable and places that they can operate with confidence. We're seeing some of those bands being stretched a little bit. So, for example, in the payment space, where traditionally getting a merchant services account from a bank is a process that takes a certain amount of time and costs maybe $50 to $100 or whatever it might be. Increasingly with online businesses, we're seeing people providing payment services that can be set up fairly instantaneously at next to zero cost. So that's kind of a disruption in the whole merchant acquiring space, etc. So we've made an investment in a business, Promise Pay, which powers marketplaces, and some of those marketplaces have traditionally struggled to get the sort of payment merchant acquiring services that they need from a bank. Similarly, in the lending space, for example, we're seeing in SME lending a whole raft of new SME operators coming up who are lending on a variety of different asset forms and doing some unsecured lending that traditionally banks haven't done, either because they haven't had the confidence to operate in some of those areas or haven't been comfortable assessing some of those asset classes or been able to do it at pace. as that space becomes more complex, helping small businesses to navigate it, I think, has become a key opportunity. And so investment in Valiant Finance is all about helping SMEs to navigate that increasingly sophisticated SME financing market. And then you've got things like peer-to-peer lending, where essentially arguably the disruption in peer-to-peer lending is the ability for individual investors to have access to what have traditionally been wholesale fixed interest rates of return. So there's some of the areas in sort of classic fintech that we're typically investing.
It's probably worth pointing out that the distinction that Simon made before about sustaining versus disruptive innovation, I mean, as a VC investing in the space, about 85 to 90% of fintech companies that we see are what we would call sustaining innovations in that classic fintech space. So they're really just doing the jobs of the bank a little bit better. And in our mind, they're not really venture backable opportunities because the exit opportunities for those are generally quite low, and the risk of incumbents outcompeting you by building or partnering around those spaces is very, very high. So it's that Clayton Christensen lens that, classic battle between an attacker and an incumbent. The incumbent always wins at sustaining innovations, and the attacker always wins at disruptive innovations. So in that classic fintech space, a lot of people who are doing PFM, direct-to-consumer robo-advice, a lot of that stuff we see is more classically sustaining innovation.
I really like that way of thinking of it. I suppose it reflective of my ignorance more than anything, but I hadn't necessarily broken those developments out into two components in my mind in that way. But I think it's a very good way to look at things, and I think it makes great sense from a venture capital standpoint.
Well, it's really to Simon's credit that we've kind of built our fund strategy on that thesis. He's been the deep student of Christensen for a long time. But we found it very, very powerful in how we put stuff together, and certainly in our conversation with entrepreneurs when they pitch us and we explain that distinction, there's definitely a light bulb moment for a lot of them. And for some of them, it doesn't mean as an entrepreneur you don't have an opportunity to get a good outcome if you're building sustaining innovation, but it does mean you need to think very, very deliberately about how you raise capital, how much capital you raise, who you raise it from, what your exit horizon looks like, what your partnering strategy looks like. And generally, you want to be capital light, up and out earlier, partnering quite early on with the organisation you think may be a potential acquirer. Whereas in a disruptive innovation, you're really thinking about this is going to take a long time to mature. I'm going to need a lot of capital to ride out the change in the dynamic in this market. And that's really where venture capital plays a key role.
You mentioned Simon's thought process a little bit, and I've had more of an opportunity to connect with him in the past than I have with you, Danny. But I should say one of the reasons I was so interested in getting you guys on the show is because precisely that the way Simon thinks about things, the reflectiveness in his thought process, I find to be fascinating, and I think he draws some really interesting high-level conclusions that may escape a lot of others as a result of that.
Yep, that's why I enjoy working with him.
I bet.
We have an enjoyable partnership because we both think we both enjoy reflecting, and Danny's brought a ton of insights and I guess nuances to that whole sustaining and disruptive distinction, and how that really plays out in practical ways in a lot of the different spaces. And in particular, when you're talking about, I guess, how do we invest in themes, one of the things that's been, I think, a real strength of our fund is, and this kind of goes to the third layer of the stack, which Danny can talk about a bit more, but one of the key ventures in our fund is one called Data Republic, which Danny co-founded prior to us establishing the fund. We put it on ice when we established the fund because we kind of had to focus. And then we partnered with an entrepreneur, Paul McCarney, and brought Data Republic within the fund. And Danny has been just living right on the edge of new developments in data, in artificial intelligence, in analytics, and seeing how those are playing out in kind of longer term disruptive ways, understanding how that disruptive sustaining dynamic is playing out in those new technology trends in very powerful ways, and it's created for us, I think, a real ability to see around some new corners in those spaces, which we hope will play out in some pretty interesting investments, which I might let Danny talk about, but some of the things in the stack that we've been focusing on.
Yeah, sure, Will. Not sure if you can hear the beatbox soundtrack in the back, but we're doing this call from a hotel room in San Francisco, and it sounds like one of our neighbours is having a party. So,
well, it's 9:30 a.m., so
yeah,
it's about time, right?
California.
Party time.
So that the third category, where actually probably a significant body of our investments are based, is in that layer, which we really call the modularization of the financial services stack, and this really reflects the trends. What happens when most value chains mature, particularly as technology penetrates those industries and value chains more, you get the peeling off of horizontal layers of capability that have been traditionally built by each individual operator in a vertically integrated stack, and then someone comes along and says, I can do that layer for you better than you can do it yourself. Why don't you buy my services in as a supplier? And invariably those decisions are economically rational and quite sensible decisions for an incumbent organization to take. So that might be at a cybersecurity layer, that might be at a data lake capability layer, that might be an analytics layer, an API layer, a credit layer, all sorts of different layers of capability within the bank. Why we think that's an interesting layer is because some of those layers, there's actually network effects that exist in those layers and potentially long-term transfer pricing dynamics, which can create a phenomenon known as disruption by outsourcing. And a great example of how that was experienced was by an organization called Dell, which outsourced continually increasingly sophisticated layers of its value chain to suppliers in Asia who could continually offer to provide those services at a 20% lower cost than Dell could. And then they woke up one day and found that all Dell were doing were buying components from a competitor and putting their brand on top at a premium price. And that supplier then launched its own brand called ASUS for less than Dell, having absorbed all of the capability to build those machines. So there are a lot of those layers emerging in the capability stack underneath the customer-facing part of a bank, which have some potentially interesting long-term implications. And probably the river of gold we talk about in the banking stack is really data. In the same way that classifieds were the river of gold in newspapers, we think about data as being the river of gold in banking. And so this whole movement to open data and access to data and data capability is an area that we've invested quite heavily in. But along those lines, we've invested at an API layer. We've invested at a data governance capability layer. We've invested in the analytics layer in a couple of different spaces. We think RegTech is another interesting example of that capability layer. We think Treasury as a service is an interesting layer. We think credit as a service is an interesting layer in that stack as well.
And it's where blockchains, and we, to be honest, are really focused on the open blockchain. So Bitcoin, Ethereum, etc. That's another layer that is potentially being unbundled from the banking stack.
Identity is another layer that we think is potentially very, very interesting and has really interesting implications over time that we look into as well. So they're all the layers in what we call the capability stack in banking, and some of those layers which have network effects, which generally they'll be winner-take-all characteristics, can become really important if you can seed those early and leverage the position of the bank in your market. Then you can potentially position yourself well for the long term.
I mean, the other example of that form of disruption through modularization, was the original battle between Apple and IBM/Microsoft, where Apple did that full integrated stack with their PC, and they really stuck with it. And Microsoft, IBM went that modular route, and because Microsoft owned the layer that had those massive network effects, it ended up becoming the dominant player in that PC market. And then we're seeing the same experience starting to play out in the smartphone. So Apple once again brought the integrated stack you could argue there are slightly different nuances, but ultimately I think we're seeing the same experience play out where Android, in terms of sheer numbers of sales, is definitely outpacing Apple with that modularized approach.
You guys mentioned, I think it was Danny who mentioned it, but data becoming the river of gold in banking. We've heard so much over the past few years about how data is going to change our experiences, everything from, social media to the way we're marketed to the way we live our lives. And certainly banking is a core component of that. We haven't really seen it delivered yet. I mean, should we expect a flip to switch at a certain point and suddenly this power of data analytics in banking specifically is realized, or is there a long road to hoe still?
Danny has a beautiful analogy that he uses about the way the data analytics market has developed, which is there's been a ton of investment and a ton of innovation around smarter analytics. And what you've ended up with is a lot of, as Danny calls it, there's a lot of Ferraris driving around with no petrol in the tank. So there's a lot of really awesome data applications around that don't actually have access to the breadth or depth of data that they need to really shift the dial for consumers. And that's where Data Republic, which I mentioned before, why we think it's such a core innovation in that stack.
There's a lot of pieces of the capability layer in data. I mean, data is as an industry, we kind of think that data is going to be as big as an industry in its own right as banking might be itself. And we think in a lot of ways that data has the same characteristics of money. And what's been missing is a lot of the same capability layers to make data as liquid and mobile, economically valuable, insurable, measurable, quantifiable, tradable, can be borrowed and lent. It's missing a lot of the same pieces of infrastructure that's been necessary to make the banking industry as sophisticated as it is today. So the bits of capability that have started to mature, which I think are really going to see an acceleration in data as an industry, are cloud computing technology and the low-cost processing power, storage capability associated with that, the progressive development in the algorithmic layer, artificial intelligence, machine learning, the increasingly sophisticated application layer technologies that are coming out, real-time processing, transmission, and then just companies themselves organizing their own internal data sources effectively in data lakes, Hadoop, Spark infrastructures, etc. So that we're kind of getting to the point where we're cleaning up and organizing data in an effective way. And now what's really missing is this banking infrastructure for data to enable data to flow freely between companies in the same way that money does. And I think where we get to that point, and that's really the objective of Data Republic, is to create a trust framework and a governance layer that enables companies to share data with each other about consumers so that we can rapidly get towards that personalized experience, transformative, service-based, real-time contextualized experiences for consumers and businesses.
In a way that still gives consumers the level of control they need from a kind of privacy, compliance, etc. point of view, that ensures that they're confident and comfortable that their data is not being misused. So it's partly about bringing data out from kind of the shadows where a lot of data analytics is going on at the moment, where people are sort of going under the radar at times in how they're using data relative to sort of privacy rules, etc., and really bringing it into the light and creating that transparency, which will in turn, we think, make the data, give people confidence enough that the data can become more mobile, can become more usable to improve their consumer experience.
Correct. In the same way that the way that we think about, me transferring money to somebody on the other side of the world, I have complete confidence that the systems underlying that are going to deliver that money, securely, that my transaction will be private, between ourselves, etc. All consumers and corporates have the confidence in the banking system around money's handled. And what we need to develop is the same degree of confidence for people in how data is going to be used. And I think when we get to that point, we're going to see a massive acceleration in the unlocking, enablement and utilization of the most significant asset that most companies own that's not recognized today on their balance sheet.
Absolutely fascinating. I think there's probably a follow-up show at some point here specifically on data and the transformative power and exactly what you guys are seeing and thinking about. Maybe I can ask you one quick question to wrap up, mostly as a way of educating our listener base, most of which is based in Europe and the US. How would you characterize the Australian market in the context of kind of global fintech and some of the challenges that financial services organizations are facing? Is it similar or dissimilar from some other countries like the UK, the US? And are there any kind of specific nuances to operating in Australia?
I think there's a bunch of there's obviously a bunch of quite strong similarities to the UK market and to the US market, English speaking being one of the keys, obviously. And, advanced Western economy, infrastructure, et cetera, which makes Australia very similar to those markets. There's a couple of, I think, really interesting things about the Australian market that make it a particularly, in our view, a great place to be doing investment, startup investment. One is for those industries where you're really selling to enterprises. It's one of those markets where it's large enough to build a sustainable, profitable business, but at the same time, its tendency is to be quite oligopolistic, which means that you can reach, in many cases, 80% of the market by tying up relationships with a small number of enterprises. So, for example, that's why we think it's been a great place to test and build this banking infrastructure for data, because of that small number of players that have a tremendous amount of data in the Australian market. The second thing that actually is an advantage, which is almost the opposite, which is for those who are going after the lower end, some of that SaaS technology, which has no enterprise sales force, for example. We're small enough that a lot of entrepreneurs realize that if they want to build a big business in that type of market, they need to be global from day one. So, for example, we see some of our colleagues over at Blackbird who are making some awesome investments in businesses that are global from day one, and because they know how far they are away from the world, the rest of the world, they're real masters at leveraging all of the online tools that are available in order to build a global business. So we see businesses like Atlassian, Safety Culture, Campaign Monitor, etc., businesses like that emerging. So I think Australia is a great place to be doing startup investment for that reason right now. It's got some really interesting advantages in both of those almost in opposite ways. The other advantage is we're extremely close to Asia. So I think there is a real untapped opportunity for us to be part of that East-West gateway. And I think we're still exploring how can we maximize that opportunity.
Look, I think the other really important consideration, particularly where fintech is concerned, where Australia is different to the rest of the world. I mean, it's got a lot of the same characteristics. We've got a very technology-savvy consumer base, very early adopters of all new technologies, very high rate of cashless payments, etc. But we didn't have a GFC in Australia. And this is a really critical distinction in the development of our fintech market. And what that meant was we didn't have the same massive distractions that I've seen a lot of the banks in Europe and the US had, where they focused internally for a very long period of time. So the Australian banks kept investing heavily in innovation and technology through that entire period of time. And so you've got some of the most technologically progressive banks in the world in terms of consumer experience and delivery in Australia. So an Australian fintech startup, I think, has to work twice as hard in the Australian market to get any traction to be out ahead of the banks. And so a lot of the companies that are pursuing interesting fintech things in Australia are really pushing out on the frontier of what that experience looks like. And I'm reminded that every time I come to the US and then have to pull out my credit card and sign for an experience in something that feels 20 years old to me relative to what the experiences are like in Australia.
Simon and Danny, what's the best way for people to find out more about your work and connect with you directly?
You can find out more about us just on our website, www.reinventure.com.au. We're both pretty active on Twitter. I'm Simon Cant. Danny is
Danny Gilligan.
Yeah. And people want to email us, then we've got our address on the site. But it's worth going to the site first, just getting a sense of exactly what it is that we're looking for.
Great. Simon Cant and Danny Gilligan, thank you very much for joining us today.
Pleasure, Will.
Pleasure, Will. Been great to speak to you, mate.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.